everybody, and welcome back to the Dash Trader Newsroom. Election volatility or market correction. So we've entered the month of September, and the markets have been volatile as expected, living up to September expectations. My name is Michael DeJoy, Director of Educational Services here at Dash Trader, joined by my co-host, Jill Molandrino. Jill, how are you?
Good, doing well. Good to see you, Mike.
Great. Yeah, great to be here. So, I mean, we got two charts up here. We have the breakout in gold is the top chart, the one that I'm going to be pointing out with my laser pointer right now. So this is the breakout in gold. We've kind of had this couple of weeks of consolidation, and now gold is breaking out. The NASDAQ has put in a higher low, and we are still kind of stuck in this range. This is the decision month for what the Fed has mentioned is going to be a rate cut. Most people are expecting a 25 basis point rate cut. There is a small chance for a 50 basis point cut. A 50 basis point cut, I've seen some things, some articles stating, is that something to be concerned about? It's kind of a large rate cut. Is that showing that the economy is weaker than expected? Just getting your thoughts on the breakout in gold and, of course, what the Fed will actually do with the rate cut that we've all been expecting.
Well, Mike, you know what? It's a great week to be discussing this. We had LBMA, which is a well-known standardization company out of London, and they focus on gold and all the standards around that. And then we also had a mini symposium with our U.S. economists this morning. So things that we've been covering as well. So certainly of interest to the DOS traders. Let's start with the rate cut first. 25 basis points. Certainly that's priced in. I think they've fairly articulated their motive and rationale behind taking it down by 25 basis points. It's interesting when you look at employment data, when you look at CPI, PPI, the data that came in this week, there were some good facets about it and some that were a bit concerning, but for the most part, it came in cooler than expected. So it justifies the 25 basis point cut, but it might be not necessarily time for 50 basis points because it still was relatively cool. I think, if our U.S. economist was saying that he would not be surprised to see if we had, 75, 50, let's call it 75 to 100 basis points. He wouldn't consider it not a surprise, but it wouldn't be as concerning to him in terms of signaling that at the end of the year anyway, that there's stress in the economy, but it's a way for the Fed to articulate a soft landing if the trajectory longer term is for the economy to feel some stress. So it's not like, oh, we got 4 rate cuts or 75 to 100 basis points this year. It's more of a mechanism for them to drive policy for that soft landing, which was, I was pleasantly surprised to hear him with that type of analysis, because my first thought was, oh, wow, if we get 100 basis points, perhaps that's signaling something. But, when you look at it from our economist perspective, it certainly, there is rationale there. In terms of gold, it's so interesting, Mike. Like I said, we had a gold expert on the show this week, and typically gold and equities do not move in lockstep with each other. And if you look at the performance of gold this year, or even a bit longer term, and Mike, you're the expert with the charts here, but it almost looks as if their longer, like call it 10-year pattern, is somewhat the same. It's a bull market longer term. We had some blips in between, but there really wasn't that negative correlation that you would expect. And, that we're also seeing in other asset classes as well. So perhaps because of the geopolitical uncertainty that's taking place here, there's also, the conversation around de-dollarization that's taking place. That's why you're seeing that performance in gold moving in lockstep with equities. So there's a lot of different interesting fundamental reasons why, but Mike, maybe you'll get to this on the technical side of this presentation, but if you do look at the charts longer term, they're somewhat similar in that respect. And again, they don't typically trade like that.
No, you're 100% right. In fact, that's one of the things I'm going to be talking about. I'm a big gold bull at this point, based on the charts. And the reason being is, number one, we're going to just switch to the next slide. Whoever wins the election, we have a little picture of the debate from earlier this week. Whoever wins the election, we know that they are going to continue to print money. And both, whether it's Trump or Harris, it's not good for the dollar. And what's not good for the dollar is good for gold. So whatever happens, with the election, it's probably going to be a good thing for the price of gold. Gold is a hedge to a weak US dollar, and a weak US dollar is almost invariably going to be the case. A weaker dollar is going to be the case because, number one, the Fed has already told us it's going to cut rates. And, whoever gets in the office is going to be spending more dollars that they're going to create out of thin air. So that's probably the reason why the long-term chart on gold is so bullish. And I mean, that goes for silver too. Generally speaking, silver outperforms gold in bull markets, and it underperforms gold in a bear market. So keep an eye on both gold and silver going forward into the end of the year. Now, September so far has been living up to its reputation for being very, very choppy and a difficult month to trade. And so far, that is exactly what we've seen September. We've also seen that the European Central Bank has cut its rates and lowered its growth forecast. And just to further the conversation that you and I have been having about job cuts, is Microsoft has just announced a 650 job cut in surprisingly the Xbox gaming unit. So we're seeing some additional job cuts, and that all goes in line with the weakening of the U.S. job market, or at least that's what I'm looking for as clues for a weakening U.S. job market. What are your thoughts on the weakening U.S. job market, the European Central Bank cutting its rates and lowering its forecasts, and of course, just the market choppiness that we've been dealing with?
Yeah, well, to your point, September is certainly living up to its reputation of being a difficult month, regardless if we're in an election cycle or not. So, I mean, there might be some seasonality that's in there, but, I think what's challenging with the markets right now, and I think yesterday's move was indicative of that, it's still really hard to discern what policy could be executed with both candidates. And and this isn't just because it's social media and it's Trump and it's Harris. Even if you go back, a number of decades, typically what's spoken about in the debates and during the campaign cycle doesn't necessarily translate into policy or legislation. Once there has been a change in power, or if the same parties remain in office. I think at the end of the day, if it's split, that's really going to be the key here, whether we're in a stalemate or one party or the other has full control across the board. Then policy might be a bit more discernible. But Mike, really, to your point, it is a challenge. I would say more traditional election cycles, if you will. It was kind of like, the Republicans tended to be more fiscally conservative. The Democrats were perhaps, more progressive socially, and there was somewhat of a balance in there to the middle. And I think the market is grappling with what that might look like. We saw at the open yesterday, I believe the S&P was down around 100 handles or 150 handles at the start
Reversal.
of trade.
Yeah.
Right. And it reversed. And forgive me, I was literally in studio all day long. So I didn't see, the machinations all day long through the market, but the reversal around lunchtime, after reflecting back was glaring. So, and we've seen this after election results have been announced, where you'll get that immediate reaction. Perhaps Wall Street, it doesn't see Harris as friendly to corporates, and she emerged from that debate certainly as the front runner. But then as it digests itself, that move yesterday, Mike, was stunning. I don't know if it was a reaction.
I was stunned by it myself. It was
Right?
it was basically lock limit down and complete
Right.
reversal. And then the reversal has continued on into today.
Right. But we saw that on August 5th as well. Yes, there was the end trade. I understand that. But then, when the employment data had come out that Friday before, and we started to get some uneasiness there, the reversals, for whatever reason, I mean, some of these, Mike, and I think we spoke about this 2 weeks ago, would take sessions, weeks, perhaps months to gain that ground back. We are looking at literally a few hours intraday.
Yeah.
So I mean,
Wide
fundamentally,
and whippy ranges tend to indicate distribution of some kind. So,
right, but like even as an intraday trader, and I know, technical analysts, they use their levels and whatever tools work for them, but it was almost like trying to identify, when it moves that much, 100 handles, let's call it an hour or two, how do you pick out where you might go short, or do you just let the full move play out and then you come back to more reasonable ranges that you can digest? I mean,
yeah,
I don't even know how you do that.
it is a very volatile market. It is excellent for day trading and volatility trading and on options. But again, if you are position trading, it is very hard to adjust to drastic moves like this. But again, this is what I would call a stage three, which is a wide and whippy range of uncertainty, which is usually indicative of distribution. The only thing is that you're seeing these patterns that go for 3 to 5 day swings, and then you'll see sharp reversal days intraday. That will either sustain that move or reverse it. So I think you just have to be prepared to be that nimble as a trader.
Yeah.
Certainly, it is more conducive to trading than investing.
So,
Uh,
Mike, I have a question for you. And I think when you were on my show 2 weeks ago, and we had another
yep.
technical analyst on, and both of you were in agreement that this was the type of market action that you had expected,
Yes.
um, almost to the day, right? And and
Mhm.
and while you were both right there, on a day like yesterday, and this is just my own selfish questions that I'm asking. If you were trying to day trade that market, would you, or would you have just stepped back? I mean, can you even pick levels
Yes.
when it moves that fast?
So yeah, so I took on a position yesterday, and I closed out 2/3 of the position because the market looked like it was reversing. And then I put on that position again today at pretty much the same prices. But again, of course, the market has continued moving in the upward direction. So I did put on a short position, or like a volatility short, for hedging purposes. And yes, you got to stay nimble, and you have to play in different time frames, because the time is your tool in trading, right? So you're trying to gauge and catch this volatility back and forth, and try to make up, for whatever, losses you might have in your long-term portfolio, or losses you might have in your short-term portfolio. But you're basically playing that volatility as nimbly as you can. And to me, I don't see this election being the end of the volatility. Whatever happens with the election, that ends the first stage of the volatility. And then you go into the between election and actual inauguration, and you have the selection of the cabinet, you have the breakdown of the Congress, and all of this is not the normal situation. We always say the four most dangerous words is this time is different. This time is a little bit different, right? Because we do have an expected uncertainty related to the election. The other thing we're seeing is that we're seeing this breakout in gold. We're seeing a bottoming out in oil prices. We're seeing airline travel, right? We're seeing airline travel getting more expensive and scaling back growth expectations. So we're seeing signs that the economy is definitely softening. And we're also seeing signs that oil prices will be going up, and that means that when oil prices start going up, you may see inflation concerns again, because oil is a huge factor in everything related to inflation. But oil has been down pretty much all through August, and all through September, all through July. So oil has been the factor that has starved off inflation. If we start to see oil start to rise again, then we're going to see inflation concerns start to rise again as the Fed starts to cut interest rates. Now, of course, when the Fed cuts interest rates, dollar goes down, so oil has to go up, because oil is denominated in dollars. So it's a very interesting spot. And the other thing I wanted to point out too is that this bull market is now 2 years old. the
Mm.
the the little pullback. So if you don't count the first rally in the market, which was like 13 years, then we had a 1 year sell off, and then we've had a 2 year bull market. So this recent 2 year bull market is kind of at the highs, and is showing signs of finally, showing signs of distribution. And that's what wide, whippy, volatile markets really indicate. So Again, this is great for traders, very difficult for investors. So,
Yeah.
that's my analysis. Any other
Yeah.
comments or thoughts before we wrap things up and go to the charts?
Mike, I thought that was a great analysis, and thank you for the lesson there. Certainly, if I'm learning, everyone else in the DOS Trader audience is learning. But when you had said it's difficult to pick points in markets like that for investors, in the same token, Mike, the action that we saw for a longer term investor, it helps to enunciate the point that staying in, thinking long term, if you try to sell, in these pockets of volatility, most likely you're not going to be able, to capture the right levels as perhaps a trader such as you can. And at the end of the day, when you look at it over multiple months, multiple years, it's a blip on the radar. So I think there's something for everyone in terms of a learning experience happening in real time here.
And we did see dip buying. So like this last little sell-off that we've had and this last rally, we have seen, I would say it's small to medium-sized dip buying, meaning that investors are dipping back into the stock prices that are seen as a value or a discount. So, and we're also still seeing sector rotation. So we're seeing some sectors that are doing fine, whereas there is some diversification going on with technology, which makes sense because it's up so much.
Yeah, of course.
Totally makes sense. You want to take profits on things that have been performing well.
Right.
So
Yeah.
that makes total sense. Well, listen, thank you so much as always,
Welcome.
Jill. It's always a pleasure to speak with you on these various topics, and see you in 2 weeks.
All right. Sounds good. Take care, Mike. Thanks, guys.
Bye, Jill.
See ya.
All right, let's jump into our market analysis. But before we do so, I just want to make a mention that we have a live dash training class at the NASDAQ market site with the closing bell ceremony. And we have a special promotion code being social 100. Now the registration will be closing up come next Monday. So we are really getting to the end of the wire there for anybody who is signing up. Again, this is in-person training on the Dash Trader platform, taught by me, yours truly, at the NASDAQ market site. We're going to start at 8:30, have light breakfast. We're going to be going over the various different styles of trading, creating layouts for each of these styles: scalping, gap trading, intraday trading, swing trading, options trading, and many more. Setting up the hotkeys, using the script editor, configuring the trade signal tool, which is part of your Dash Trader platform, and going over some advanced features inside of Dash Trader. I will be taking everybody to lunch in the area in Times Square, and then we will be going at 3:30 to the NASDAQ closing bell ceremony, and then afterwards we're going to be having a cocktail hour hosted by yours truly once again. All right, before we wrap everything up, I'm just going to bring one more my Dash Trader up. Okay, let's do a quick look at oil. So, when we look at oil here on the chart, I'm just going to bring up our weekly chart. I mean, we've really come back to support on oil. Okay, so we've pulled all the way back to support on the chart of US oil. We have gold, GLD. All right, so we have gold. This gold is basically a straight up and away uptrend. SLV, which is silver, breaking out to the upside as well with silver. Looks like silver could be rising up to 29.75. If it breaks above 29.75, we're breaking into kind of new high territory, 52-week new high territory on silver. We got the QQQ, right? QQQ is basically up to the top of its prior bar on the weekly chart. Now, this pretty much can go anywhere. Like, you can go higher, you can go lower, but generally speaking, on a weekly chart, you're going to get a pause here, right? Like, we wiped out last week's downward action, and now we are back to the top of last week's start of downward move. Now, this week, we've kind of come back to resistance. This kind of volatility is very, very, indicative of, of volatility and distribution. Last but not least, let's take a look at Goog, right? Google and Apple have had some very bad news, losing their case with the European Union. So we've seen Google on the down. So this is that technology sell-off. We see We see this is Microsoft bouncing back a little bit. We got Apple also, doing very well, holding out here near the highs. And we got our latest darling, NVIDIA also bouncing back to the upside. Tesla, a little bit of a dog lately. Not terrible, but kind of making a bear flag pattern. That's pretty much it for our market analysis. We kind of covered some of these things in the in the actual presentation today. So I'm going to wrap up the market analysis section and just wrap up today's presentation. I would say the best thing you can do as a trader is just be cautious, take your money and run. When you have profits, take them quickly. Certainly stay up to date with all things DAS by signing up to our monthly newsletter and emails. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our new YouTube channel, DAS Trader TV, and the DAS Newsroom reminders by clicking on the little bell. Certainly stay up to date on all of our social media outlets. We've done some additions and updates to the way our social media is presented on Instagram, Facebook, Twitter, and LinkedIn. We'd love to see you and hope that you join us soon on any of those outlets. Thank you very much. Stay up to date and see you in 2 weeks. Trade well, everybody.